Hello and welcome to Moneycontrol. I'm Kaydzad Adajania. What is the most important thing or the first thing that investors look at before investing in a mutual fund? The answer is returns. But many advisors, fund managers, and experts have often said that looking just at returns before investing in a mutual fund is looking like in a rear view mirror while driving a car. The answer is to look at the risk adjusted return. Now, the question is what is better, return is better or risk adjusted return? To talk about this, I have two experts with me in the studio today. Please welcome Chirag Mehta, who is the Senior Fund Manager, Alternative Investments at Quantum Mutual Fund, and Dhaval Kapadia, who is the Director of Portfolio Specialist at Morningstar Investment Advisor Private Limited. Chirag has been with Quantum Mutual Fund as a fund manager for the past 16 years, and Dhaval has been with Morningstar for the past 7 years and has worked at Axis Wealth and Private Banking Division and at ICICI Bank before that. Hi, Chirag, and hi, Dhaval. Welcome to our show.
Hi, Kaydzad. Thank you for having me.
Hi, Kaydzad.
Hi, hi. So, Chirag, let me just first start by asking you that many investors still invest in mutual funds looking at the past returns, but they ignore the risk. Okay, broadly speaking, before we go into the nitty gritty, can you just give us an overview of why looking at risk is important as well?
Yeah, sure. I think the essence of investing is the risk and returns are two sides of the same coin. If someone tells you that you can earn returns without any risk, that's not true. And if you are investing, there will be an element of risk involved when you are earning a return on your investment. So if you look at uh, if you want to generate an X amount of return, there has to be an element of adequate risk involved to help you achieve that kind of return. But the flip side is not so true. When you are trying to, it's not that you have taken a risk and there will be a return following it. It could well mean that you could lose your money as well. So risk is very, very important, and you understand the risk that you're taking. If you're comfortable with that risk to generate the kind of return that you're looking for, or you're not. So there are different types of risk, and risk can be categorized into various different ways. One easily that most people look forward to is volatility, but volatility is in essence just an up and down movement. It's not really risk. Risk is about how much money you could lose on any given day, right? For example, if you're investing in equities, any given year could be down 30, 40, 50%. Are you able to digest that kind of volatility? Then only you can have a higher allocation to equities. If you're not able to digest that kind of volatility and ups and downs, then you need to move into different asset classes. So there are various types of risk, be it valuation risk, be it an opportunity risk, be it the risk in terms of the volatility or the downside that we spoke about. You investors need to understand that there is a risky element involved in it, and what kind of risk they are ready to accept when they are investing.
Okay, okay. Dhaval, you heard what Chirag said. He mentioned about equity risk. He mentioned about not volatility not being the risk. I mean, it's how much you can actually take. And that the volatility translates to is what the risk is something that you have to associate it with. But the fact of the matter, Dhaval, is that risk is present across asset classes, across mutual fund categories, right? It's not
Right.
just equity risk. Even a
Absolutely.
liquid fund, carries risk. This is something that can you elaborate more on this? Because people feel that there is all the risk is there only in equity funds and debt funds, especially liquid funds, ultra short term funds, bond funds. There is no risk at all.
Sure, sure. Just taking a step back, when we talk of essentially liquid funds, ultra short-term funds, or other debt funds, obviously invest into debt instruments, right? And what is the typical kind of risks that are involved in debt instruments? Typically, two types of risks. One is interest rate risk, right? So interest rate risk essentially is depending on how interest rates move, it impacts bond prices, right? And in very simple terms, they work in opposite directions. So when interest rates move up, bond prices tend to move down, and vice versa. So we've seen some of that happen over the last couple of years, say from 2019 till about 2020 or so. We saw interest rates come off. So the RBI was cutting interest rates, particularly after the onset of the pandemic and so on. So you saw bond prices come down, sort of go up in that sense, right? And in more recent times, you've seen concerns around interest rates sort of moving up, and RBI probably starting to hike rates over the next few quarters as such. and you've seen bond prices drop. So in other words, one of the key risks associated with debt investing is interest rate risk. The second type of risk is credit risk, right, which is nothing but the likelihood that you may not, as a bond holder, or as the fund house being the bond holder and you being an investor in that fund, the likelihood that there is a default, either in terms of the coupon that is due to you as a bond investor, or the principal that's due to you. So effectively you're saying that the two key risks associated with debt are interest rate risk and credit risk, as we said. Now, coming back to your specific question around liquid funds and ultra short term funds, as we know, these kind of categories, they tend to invest in short term bonds, right? So they tend to invest in bonds which, liquid obviously can invest only in securities maturing up to 3 months, and ultra short term would tend to be in the up to 1 year kind of bracket, right? So typically when it comes to interest rate risk, it tends to be very low, or it tends to be pretty low for bonds with a lower residual maturity or duration. So if I'm investing in a bond with a 3 month maturity, as compared to a bond with which has a residual maturity or a maturity of 5 to 10 years, my interest rate risk in the shorter tenor bond will tend to be much lower. So in other words, because liquid funds and ultra short term funds invest in short tenor bonds, the interest rate risk element is low. So in other words, the impact of interest rate movements on short term, on prices of short term bonds tends to be lower, right? But that still
Yes,
leaves us with credit risk. Yeah,
correct. But the thing is that interest rate risk, credit risk are there even in shorter tenure funds. Also, of course, they would be in
exactly.
different proportions. But it's not like a liquid fund or a short-term bond fund is like an alternative to a bank fixed deposit. So assurance of return is absolutely ruled out, and there will be an element of risk even in those funds, even in those debt funds.
Absolutely, absolutely.
Okay, okay.
Yeah.
Chirag, I want to again take a step back further,
Sure.
and when you see, I'm just talking from an investor's point of view. It's easier for an investor to understand return. It's easier for you fund managers or people like Dhaval to talk about returns and be understood by the retail investor. But the moment when you talk about risk, okay, there investors often the first question that investors ask before even trying to decipher what risk is that whose risk here are we talking about? Are we really talking about the fund manager and the amount of risk that he or she can take, or are we talking about something called as a risk assessment, that you look inwards, investors have to look inwards and ask themselves, how much risk am I comfortable in taking? So are we talking about any one specific kind of a risk, or is the one specific kind of a risk more important, or when you are assessing risk, a holistic approach of risk is more important, taking into account both these sides?
So it's matchmaking, right? It's about saying how much risk I can afford to take, or how much tolerance I have for risk, and is that in sync with what funds I'm investing in? Is the fund manager taking as much risk that I'm comfortable taking or not? So that is precisely the point. It's matching both sides in terms of your tolerance as well as what fund manager does. To give you an example, say why risk adjusted is also important is because, say, two funds over a 10-year period have given you same returns, right? But one fund may have taken a higher risk to get that return. So over next 10 years, if you're investing for another 10 years, then you have to see which fund has taken lesser risk to achieve that return, rather than going into a fund which has taken higher risk. Because today the fund manager has taken that risk, the calls have been right, but what tomorrow if the calls kind of go wrong? For example, to give you some risk in the mutual fund industry, when you're investing, say simple things like portfolio turnover. So if a fund has say very high turnover of 200-300% versus a fund having 20-25% of turnover, that fund which has a higher churn, 300% churn, will mean that the portfolio manager moves the portfolio completely 3 times in a year, which will mean that it's more short-term bets that that the fund manager is taking, as opposed to a long-term bet that the other fund manager, which is having a 20% turnover, which is a view of 5 years, and taking those kind of calls. So the probability of fast turning is that your calls are going right today or have been in the past, but tomorrow it could be very very different landscape. Your calls may start going wrong because it's more short-termish bets that you're taking versus a long-term, more patient investing that the other fund manager is doing. So you have to bet on something that looks more consistent in nature rather than something that's frequently changing, and you're betting that that change will keep on doing the right way in the future. So you always have to take into account a risk adjusted return rather than just a return, because both are very very different things.
And as you rightly said, it's a question of marriage, right? I mean, it's how much risk I as an investor want to take vis-a-vis how much risk the fund manager is already taking in this fund, and there has to be a match between the two. But Chirag, tell me, does the risk, again, a very academic question, just to make this concept more understandable from the listener's point of view. Does the risk come down over a period of time? If I'm investing, you took an example of 10-year
Yeah.
fund investing for the next 10 years. If I'm investing for the next 10, 15, 20 years, does it really matter to me how much risk the fund manager is taking? I mean, does it not get evened out over a period of time? Because people anyway say that you invest for the long run, you will ride out the volatility. So does that mean that I can sort of take a slightly linear view of risk if I'm investing for the long run?
No, the risk of volatility certainly comes down over a long period. But what happens is, if the fund manager takes wrong calls, then those that lost capital is not going to get recouped, right? So you have to see in a way that, is that a higher risk? Is there more downside to it? For example, let me give you an example here. Say today, many of the tech stocks in the US, or many of the much of the platform companies in India are kind of not looked at the current cash flows or how the business is doing currently, but on more aggressive discounting of future cash flows. And if you're doing that at, say, lower rates that prevail today and are not normalizing that interest rate risk scenario, then you might be taking a higher risk than what you should have been taking, because you always have to discount in the normalizing of an environment or of an economic cycle. And if you're not doing that and betting on just the extreme of it, then probably you might be in for a surprise. So the number of calls that fund manager could go wrong because because the calls are not going right, then probably there is a higher risk there, as opposed to just volatility risk, which could be just an up and down because of the market movements. Beta itself could cause you to have that volatility move up and down, and that may even out over a period of time. But the loss in terms of the real losses that the fund manager takes because of the wrong calls, that are going to come back, right?
Okay. Dhaval, you heard Chirag's talking about risks other than volatility risks. He talked something about beta also. So let's start from the very basics. I mean, it's easier for investors to look at returns, identify returns, comprehend returns. Something which is given like 20%, another fund which is given like 15%. So one can easily look at these two numbers and say which one has made more money than the other. But where do you go by? Where do you start? Where do you go when you want to start looking at the risk? What is the
Sure.
first step?
I would think, even when you look at returns as a parameter, right? And like you said, it's easier for investors to look at, that as a parameter and compare it to others, in the peer group as such. One thing that one could do is not just look at trailing returns, but try and look at calendar year wise returns, right? And what that can show you is that, say, if you look at calendar year wise returns, over the last, 10, 12 years, assuming the fund has that kind of track record, right? Or even if it's 5, 7 years, there will be periods when the markets haven't done well. You saw a big drawdown in 2020 when markets corrected by in India by about 37, 38%. You've seen several periods in the past where markets have been volatile or have been have corrected sharply. So the key thing to watch out there will be how has the fund performed during those periods, right? Versus its benchmark. Say if it's a large cap fund, when the markets were down, say if the markets were down 35%, like we said, March 2020, how did the fund perform during that period? So my point is that try and look at returns across different market cycles to be able to understand and appreciate the kind of the not only the returns but the risk that the manager has taken, how is it performed on the downside, right? So I think that can be a good starting point. uh, there are simple ratios that one can look at. For instance, this is part of a ratio that we call at Morningstar as an upside and a downside capture ratio, right? When markets have not done well, how has the fund performed versus its benchmark, and then you can compare this parameter across different funds within the same category, right? So that could be one measure to sort of look at. When we're talking of drawdowns, the other thing that one can look at is also the recovery period, right? If there has been sort of a fall in the markets, the fund has seen a correction of say 20, 30, 40%, how long has it taken for the fund to recover recover the original sort of, if you started with a 10 rupee investment and due to the correction it came down to say 70 rupees, how long did it take for the fund to recover, or rather 7 rupees, how long did it take for the fund to recover that original, the peak level of investment, which was 10 rupees initially? So we call that as a recovery period. So some of these parameters are available on the web as well. For instance, our own websites on morningstar.in and others do offer some of these risk ratios and parameters that one can look at to try and understand the level of risk involved in funds as such.
Sometimes the well funds also, you spoke about the recovery. That's an interesting concept. But sometimes funds also take longer time for recoveries because their strategies themselves are really not suited to the current environment. I mean, you can say on the one hand that they've taken a longer time to recover, but on the other hand, the truth may well is be that the strategy itself is suited for a particular market condition which is not prevalent at the point in time. So
Yeah.
is it okay to penalize the fund when you are investing in that fund, or should you also be sensitive to that factor?
You can also be sensitive to that factor. The other thing that you'll also want to watch is different cycles, right? I mean, if you tell me in every cycle that the manager is taking much longer to recover, then I would be a little more concerned. But if it's in one particular cycle that the manager has underperformed, right? Like a classic case is like 2018-19 kind of period when you saw essentially quality and growth. So sectors that had strong growth prospects do very well, and other sectors didn't do so well, right? And so would you penalize a manager for that? So I wouldn't necessarily penalize a manager who's following a style which is slightly more value orientated, or may not be investing very heavily in quality and growth kind of stocks or names. So I wouldn't penalize a manager for that. But then I'll watch it across different cycles, that how is the manager able to sort of, is that repeating across different cycles, or is that a one off kind of a situation?
Okay. So, when you're planning for your financial goals, Dhaval, Chirag, I'll come back to you after I finish this question. But Dhaval, when you are doing your financial planning, okay, why is risk-adjusted return so important? When you have some goals in front of you, ahead of you, some 10 years down the line, or 15 years down, could be even 3-4 years down the line.
Exactly, and it's it's a great question in the sense that to an extent, I mean, the investments that you're making or a plan that you're making will be linked to the horizon that you have in mind, right? So for instance, if it's a 3-year or a 4-year goal that you have, you don't want to be putting too much money into small and mid caps, or for that matter even your equity allocation itself probably might be more moderate, say about 40-50% of your portfolio, right? So in other words, from that point of view, it's important to try and assess uh, you know uh, what is the time horizon that you over which you're aiming to achieve your goals, and therefore the risk assessment comes into play. So in other words, what we are saying is that if I have uh, a 3-year goal versus a 10-year goal, right? In a 3-year goal, my allocation to one is equity might be lower, but even within that, my allocation to small caps might be even smaller. But if, as my horizon increases, say going to a 10-year, 15-year, I can take more risk, right? My risk taking capacity increases because I have a longer time frame to work with. So there I can add more equities to the portfolio. I can increase my allocation, say to small caps and categories such as those where the volatility can be greater over shorter term, but longer term they should do well. So I would think, even if you're constructing a financial plan, it's important to keep that, the risk element in mind, even if you've got longer term, because you'll have, goals over maturing over different time periods.
Chirag, what do you have to say about that? I mean, when you're planning for your financial goals, is it really that important to look at risk and risk adjusted return?
Yeah, it does matter because, say if you're doing a financial planning and if you're heavily invested in equities, for example, say some of your goal is maturing in, say, year 2008, right? Markets down 50%. If you're heavily invested in equities, you're not meeting your goal, or you don't have enough money because equities were down more than 50%. Similarly, 2020, right, when markets were down 40% in just 1 month, some may say that global financial crisis were more predictable. You could have lowered your equity allocation, etc. But 2020 COVID, no one predicted, right? So if COVID comes in, you have your kid's education, and you have to pay fees for that, and your market's down 40%. What do? Right? It did recoup very fast, but it could have it could have elongated much longer than one would have anticipated. So these episodes tell you that just banking on the highest return generating asset class may not be good enough, right? You don't know when any uncertainty strikes and markets are down and your portfolio is down. You don't have enough money to pay for your goal. So that is why that is where taking into consideration and diversifying across asset markets really helps. Like gold, for example, in 2008 was up 31% in that year when equities were down more than 50%. Even in 2020, when equities were down, gold was started to do well. So it is emanating from the fact that there is risk in that asset class, and therefore you kind of asset allocate and diversify yourself into other asset classes. So I think risk is very, very important because you don't know the uncertainty that can impact any particular asset class, and then for you kind of risk mitigate and spread your assets.
It's interesting, Chirag, that you mentioned gold. Gold investments in ETFs, gold ETFs have really picked up in the last year and a half to two after the gold prices really started to zoom up. But I know that you guys have been people at Morningstar, Dhaval, Chirag, you, and so many other investment advisors have been telling investors to diversify to even gold assets also, not just think only about equity and debt. But presence of gold also became more important when after the gold prices actually started to go up, in 20 I suppose what in 2018, 2019 rather. And then that's when people really started to is started investing in gold and gold ETFs in a big way. And just as when people started to warm up to gold investments, they actually started looking at gold as a return maximizer. But there again, you had to control their emotions and tell them that look, gold is not to be used for return maximization; it is to be used as a hedge in your portfolio. So obviously, asset allocation and diversifying across assets is also one way to bring down the risks in your portfolio. Am I right?
Yeah, that's absolutely right, Kaydzad. I think, and it has played that role, right? If you had gold in your portfolio, incrementally you kind of increase the allocation to gold. You at 10 to 15%, you reach a point where it doesn't impact the portfolio returns, but your risk is significantly lower from the asset, and therefore we kind of recommend that you should have about 10 to 15% allocation to gold. And it has worked time and again, be it any crisis, be it the global financial crisis, be it the COVID crisis, or be it the current scenario that we are trading through, where your tensions on the Russia-Ukraine border and other assets market have been falling, and gold was one doing well. So time and again, it has that risk mitigation properties, and it does help you to effectively diversify your portfolio risk.
Okay, Chirag, give us a sense of what else in terms of your stock picking, in terms of the sector picking, does Quantum look at when it really comes to avoiding risks or minimizing the risks, and even if it goes against the tide, against what majority of the other industry players are doing. I mean, I believe you guys never invested in Satyam at one point in time, even when the going was good for the company. Even in recent times, I believe you guys have been away or largely away from these internet-based, startup companies that are getting listed at
Yeah.
crazy valuations, but there's no profitability at site. So, does it give us a sense of how your assessment has been over time when you assess these kind of companies? I mean, of course, now that you have the benefit of the hindsight, but what goes into your mind when these companies come about and when things are going good? What are the typical red flags that you actually see in these companies that make you say that, okay, this is not the right investment for me as a fund manager?
Sure. So at Quantum, we have two equity strategies. One is value, which has been our flagship strategy since 2006. And more recently, in 2019, we launched the ESG equity fund. So in both the strategies, if you look at corporate governance, sits at the heart of our analysis. Corporate governance, we think, is very, very important. And by having that emphasis on corporate governance, we have kind of avoided the landmines in corporate India. And we have seen that failures of corporate governance have led to collapse of many of the companies out there in the Indian corporate arena, be it any of the sectors, be it say banking, be it airlines, be it FMCG. So we have seen many companies kind of go down because of issues surrounding corporate governance. And I think Satyam was one of the biggest example that you gave, that we never invested in Satyam despite it being a big part of the index in those days. We kind of were not comfortable with the books of the company, and therefore we kind of avoided that. We were not comfortable with the corporate governance of the company, so we avoided that company altogether, despite it being a higher part or an integral part of the index in those days. So we've kind of corporate governance, our ground level checks, our checks on promoters, our checks on the management, our checks in terms of what their history has been. Not It's not that we just look at the current scenario and how they kind of behaving and operating. We look at the history and see that are we comfortable with that kind of that management or that group or that promoter or not. Our thing is simple. We kind of shake hands with someone, and if we don't get five fingers back, we do not shake hands with that person again. So that is how we kind of have very clear rules in terms of what we have seen in the past. There is a probability of that occurring in the future, because many of the companies, many of the groups have not dealt with minority shareholders in the right manner. So when it comes to that, if we do not compromise on that at all, uh, so that has been a cornerstone of our investing, and we think that has worked well to avoid the big landmines out there. Uh, when it comes to the new age platform companies, what is happening is, we have a value style of investing, and we kind of give a lot of emphasis on the cash flows that the company is generating. And when it comes to looking at that, these new age companies, if you look at the way Street is discounting it, it's looking at more of not what is today, but looking at aggressively discounting the future of those companies. So that does not give us the valuation comfort that we are looking for. And when it comes to these companies, these are new age companies, have recently come, or in the last few years have come into foray. And we haven't seen how the companies behave during a bad economic cycle, how they kind of we had a downturn, but it was advantageous for most of these companies because of the lockdowns, these internet
And they were
kind
kind
of
of
companies.
disruptors also.
Exactly. So they were disruptors, and the situation kind of helped their cause, right? They kind of helped them further their businesses. So they haven't seen real downturn, which is kind of impacting them. So we have to see how they kind of behave, what kind of capital allocation decisions they take over a period of time. Plus, these managements are new; they are untried, untested in a way, and we have to see them behave over economic cycles. So given that all together in terms of cash flows, managements, the kind of businesses, that does not give us that comfort to invest in these kind of companies. So we haven't really ventured out. We do keep a track of all these companies, but it's not come to our comfort level from a valuation perspective.
Dhaval, what is your sense of the risk assessment success ratio from the mutual funds point of view when you see a lot of other mutual funds investing in these internet-based companies at the valuations that they do? And then, many of them actually exit these companies after the anchor book period is over. I don't want to name the fund houses, nor do I want to name the companies, but we know what we're talking about. So what is your assessment when you do your ratings, ranking analysis, you guys meet fund managers often. Are you satisfied
Right.
with the way fund managers are at large assessing these companies, or is it all a very short-term listing gain kind of a trend?
Yeah. I think what's very important to keep in mind is what is the fund manager saying and what are they doing, right? So if the fund manager says that, all right, this is my style is more, value tilted, I will look at, valuations more closely, and I will tend to sort of the stocks that I buy, I will tend to hold them over the longer term. If that's their professed style or that is what they communicate, and then we try and look at how that gets backed up in their portfolios, right? So in the sense that, if somebody like that is trading a lot, and probably they are not able to sort of rationalize or provide us a logical reasoning, why they've bought certain stocks or invested in certain sectors, then that raises a red flag, right? But the point I'm trying to make is that it's not that everybody who's buying into these stocks or these companies are essentially wrong, or they are one would paint them in a separate way. I wouldn't really do that. Like I said, it's more to do with the style of the manager. For instance, if they say they have a more quality and growth kind of focus, and they have a rational or a logical reason behind which they're buying. And you also have situations, or managers that say, all right, a certain portion of our portfolio we will tend to trade a little bit. Now, if they have expressed it, and if that works for them, then we don't see a reason why that's really wrong or incorrect. But our concern would be when there is inconsistency in between what the manager says and what they do. So that's the way
Okay.
I would we would think of it.
So trading, I don't recollect any fund houses actually saying that it's okay for us to trade in a certain a portion of a portfolio. But yes, the excuse
But they,
that fund
yeah.
managers have often used, that we are only investing 1% or 1.5% or 0.5% in these new age companies, so it's okay for us to get in and get out. So that's, I mean, how acceptable is it for you, Dhaval, when fund managers give that as an excuse to invest in some of these new age IPOs and then getting out within 2 months?
I wouldn't, again, like I said, that probably because we have one-on-one kind of conversations with these managers, and and they do at times do agree on this, or they do express that a part of their portfolio, like I said, there would be some trading activity that they might do. There are a few managers out there. I wouldn't say it's across the board, but there are a few managers who do that. uh, yes, somebody investing and exiting, say being part of the anchor book and exiting once the holding period is over and things like that, I think it's the call of the manager. I wouldn't really necessarily paint it either way, unless you see that on a large portion of their portfolio, right? So for to a certain degree, if a manager feels that, all right, this is where I can generate gain. So it goes back to the same point. What is the style of the manager, what is it that they're conveying, and what is it that they're doing in their portfolio. Like I said earlier, if somebody says I'm buy and hold, I will not do any trading, I will not invest and exit over a few months, after a few months and things like that, and if they actually do that, then that would raise a red flag for us. But just somebody investing and exiting after a point, I don't see, at least we don't see by itself being an area of concern.
Okay, okay. Chirag, let me bring you in. I think we're running out of time, so I have a couple of more questions to ask you all. One thing is that, and I want to just, take a step back and ask you this: that too much focus on risk, just to be the devil's advocate, does it make the fund's returns unattractive? Does it make the fund house's proposition a little unattractive? Because at the end of the day, and this is where we started off by saying that what investors understand is return. What they don't understand as much, or what they ought to understand as much, is the risk. But they don't understand in risk, appreciate risk as much as people appreciate, let's say, a 17% or 20% return. So does how should fund houses overcome this challenge of being relevant in the investor's eyes, at the same time keeping one eye on the risk and not compromising on that?
So they have to look at risk in a way, but at the same time, they have to grab the opportunities as well. As you know, any kind of company that we invest into, there is certainly an element of it. There is an assumption going. There is a research-backed decision that has been made. But at the same time, even after that, there is an element of risk. It's not sure that we invest and there is a return to be made on that investment, right? So we have to look at what are the risks, because assumptions could change, economic environment could change. There are many factors that could impact the decision that we took. So we have to look at that risk element at all times as well. But at the same time, grab all the opportunities after doing a thorough homework on the investment decision that we are making. So it's not that because investors are basing that decision on the fund manager, saying the fund manager will help me navigate the treacherous market conditions and help me, generate a good, decent return over the long term. So when they do that, when they rely on the fund manager, they are ensuring or they are putting that onus on the fund manager to navigate through the risk that they observe in the marketplace. But it's our duty as a fund manager to also tell the investor that these are the risks that we are taking, these are the opportunities we are grabbing, and that is out there in the open, right? In the fact sheets, investors can question in terms of what you bought, what you sold. So there has to be an element in terms of the risk that the fund manager is taking, and communicate that well. So I don't think that leads to compromising on the long term returns, because when you are emphasizing on risk as well, you're trying to avoid failures, you're minimizing the downside risk, you're removing that panic selling decision that you need to make. So overall, it does tend to deliver that long-term risk-adjusted return that investors are actually looking for. They do, wrong benchmarking, or wrong comparisons, but at the same time, they should be true to themselves in terms of saying what is the risk I've taken and what is the return I have made. Is it enough for me to achieve my financial goal or not? And if that is, then I think it should be fine. Because when you're comparing, say a value manager in a time when growth stocks are doing well, it may not be a suitable comparison, right? You also have to see across time frame, across cycles, and see how that fund has delivered, and it has delivered a long-term good risk-adjusted return or not for me.
So, Dhaval, aside from communication from fund house, as what Chirag was describing, what else do you think can be done to popularize risk-adjusted return over return in the eyes of the investor?
I think, third party platforms, or I would say even advisors, right? I think play a critical role. I mean, research firms such as ours play an important role as well in terms of putting things in the right perspective, and why should investors, and trying to simplify it, right? I mean, like we say, just when you hear the term risk adjusted returns, it sounds pretty
Yes,
heavy, right? So
very
how do
academic,
you,
very academic.
yeah, yeah, so how do you simplify it, and how do you really communicate it in a way that investors are able to understand it well? So I think that's the job of I would say, the fraternity as a whole, right? Whether it's yourself in the media, or I mean, media as a whole, or advisors or research firms such as ours, and of course, fund houses. So I think trying to communicate things in a simpler way is what obviously the industry is aiming towards it, and they are trying to do a lot of things around it. But I think as time goes by, I think we need to keep things as simple as possible for the end investors in terms of communication.
Right, right, right. Thank you so much, Dhaval and Chirag. I'm afraid we've completely ran out of time, but it was wonderful talking to both of you about risk-adjusted returns, about risk, and what sort of risks that investors should look at, what sort of risks that fund managers are taking that investors can comprehend. So, thank you so much for a very lovely, insightful discussion. Thank you.
Sure.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.